it feeds into this narrative that the UK is quite unfairly unloved. So for years and years, everyone has had this really negative perception of UK equities, which makes it really fertile hunting ground for value investors.
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined this week by my Fidelity colleague, Jemma to talk about how you can put a value on stock markets. With a little bit of knowledge, you can use valuation measures to compare different markets around the world and make a judgment about which ones are cheap, which ones are expensive, and therefore which ones have the best chance of making money in the future, in theory at least. Towards the end of this video, we'll show you the cheapest and most expensive stock markets that you can invest in today. Before that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussion in the comments. It really does help others find what we're doing here, and it means that you're going to get new content as it is released. That said, Jemma, welcome along. How are you?
I'm very well, thank you.
Good. Let's start, shall we, with a very brief introduction to valuation measures. Why do we have them, and what are the most common ones that people are going to encounter when they start looking at putting values on assets?
So I think it's probably easiest if we look at individual companies. So take Tesco, for example. It's a listed company, so it has a share price, and that share price will move up and down depending on loads of different factors. But when we're thinking about valuation, we're thinking about whether ultimately that share price is expensive or not, and we're making a call on whether it's going to go up or down in the future. So there are loads and loads of different ways people value companies. One way that's favoured by professional investors is something called intrinsic valuation. And that's basically based on the theory that if you could see into a company's future, you knew all the cash flows it was going to produce, you could work out its intrinsic value. But that is incredibly complicated and relies on a huge amount of guesswork. So much more popular are relative valuation metrics. And that's essentially where you take a company's share price and compare it to some measure of its earnings power.
Yes.
So that might be like profits, dividends, revenue, and you end up with a number which you can look at and compare to other companies or compare to the past and try and gauge how well valued that company looks at that point in time.
Yes. And so just like you can put a value on a company in that sort of way, you can also put it on a whole market, right? By sort of aggregating up all the companies in that market.
Exactly. And one of the real sort of bread and butter valuation metrics you have is the price to earnings ratio.
Yes.
That's when, so if we go back to the Tesco example, you would look at Tesco's share price and you would divide it by its earnings per share and you would end up with a number. And very, very generally speaking, a high number suggests a company is highly valued and has really good growth prospects. And if it's a low number, it looks pretty cheap. And you can also take it and compare it to, for example, Sainsbury's price to earnings ratio and use it as a comparative tool.
Yeah, and that's something I want to really surface in this conversation today. It's how to use these things, because on their own, they're actually of quite limited use.
Yes.
It's really having that context around them and knowing how to compare them that really, really matters. You mentioned price to earnings. A kind of extension of price to earnings is something called CAPE. CAPE. What is that?
That's basically PE ratio's fancier cousin, really.
Yeah.
So rather than just taking an earnings figure, for example, from the past year or the year to come, it looks back over 10 years, averages out what that company's earnings have been, and then adjusts it for inflation. So people like that ratio because it provides a bit of a longer term view and it irons out some of the strange fluctuations in earnings you get year by year. So for example, if a company had a weirdly good year, its price to earnings ratio might fall quite dramatically, but it wouldn't really be representative of what that company's usually like.
Yes.
So that's why people like the CAPE ratio.
Yeah, and we're here to talk about stock markets in general. And we're going to bring up on screen now something to show some valuations for the major stock markets. So we've got, if I can read this, UK, China, emerging markets, Europe, Japan, and the US. And what we've got here is those last two measures you spoke about. Price to earnings on a forward price to earnings basis.
Yep.
And CAPE as well. This is quite a good way, I think, of showing, well, first of all, the difference in valuations of different countries. I mean, the US stands out there. That's an expensive market versus other regions around the world. UK, poor UK on the left-hand side over there,
Yep.
the lowest valuation of these markets. But it also shows us the difference between those two measures, the forward PE and the CAPE. So what's going on there?
So I think the key thing to realise is that the forward price to earnings ratio is, as the name suggests, forward looking. So it's based on what people think these companies will be earning in this next year. Mm-hmm. Whereas the CAPE is backwards looking. It's looking at the last 10 years of earnings. And I think we have this discrepancy at the moment, particularly in the US, because a lot of US companies are growing their earnings extremely quickly.
Yeah.
So while their share prices might look very expensive on a historic basis, when you think about what their earnings could be, they actually look far more reasonably priced.
Yeah, and those forward earnings expectations, they're kind of based on the company's own sort of estimates for what it will do, right?
Yep, and there's also like teams of equity analysts poring over the results, coming up with like target prices, profit forecasts, you name it. Particularly in the US, where you have these really, really big companies, you'll have huge numbers of analysts looking at their numbers.
Yeah, exactly. And what's interesting, looking at this chart on the right-hand side there, the US, that CAPE figure, that's very, very high, obviously much higher than the rest of the world, but a bigger differential between its PE. And as you say, that's really reflecting the acceleration of earnings that a small group of companies have got in the US, the big tech companies, basically.
Yeah.
That probably 10 years ago weren't making that money. And that's perhaps why it's not reflected in the CAPE figure in the same way. And so you get this big difference.
Yes, exactly.
Okay, there is a bit technical. I do understand that. But I think it does show having just these measures on their own without some kind of sort of contextualizing is probably not enough, is it? You do need that extra context to understand what is going on underneath the surface.
I think that is absolutely crucial, because whatever valuation metric you want to use, if you're looking at it in isolation, it's probably not going to tell you exactly what you need to know.
Yeah.
It's a bit like anything in life. If you pay a tiny amount of money for something and you think you've got a bargain, then it breaks down. Yeah. Is it a good buy? Often you pay for quality. And in the world of stocks, high prices sometimes suggest sort of high quality companies or really good growth prospects. Yeah.
And actually, that's what we're going to come on to now, because, again, it's always interesting to look at the US in these kind of discussions, because if we bring up the next chart, it is more highly valued than other markets. This chart tells us something as to why that is. It takes a bit of explaining, but we've got the blue, red and yellow lines. They show different valuation measures, don't they? The kind of valuations that specialists will look at when they're kind of assessing a company. We've got return on equity, operating profit margin, and we've got free cash flow margin. Now, we don't need to get into all the technicalities of what they mean, but they're basically all denoting quality of earnings, quality of or the ability of these companies to make money. That's a kind of shorthand, right?
Yeah, so if you just home in on return on equity, for example, that's basically how well companies can use shareholder money to generate profit. And as you can see in the graph, the US is streets ahead of the other regions when it comes to return on equity.
Yeah.
And then you can see Japan as a point of contrast, which is really lagging behind. And that's because it's had years of deflation and corporate governance issues within its stock market. So when you're thinking about valuation, you always have to put a quality lens over it, really, to think, actually, what are you buying? And do you want to buy the very best companies? If you do, you'll probably have to pay more for them.
And it's to do, I guess, also with the composition of the market in a particular country. Not every market contains the same mix of sectors or industries, and that can make a difference, can't it? Because some sectors, with tech, bring that up again, that's been very good at just generating lots and lots of earnings, quite capital light in areas which people believe are going to grow in the future. All these things mean that people are willing to put that higher valuation on them.
I think so. So if you take the US and the UK, for example, as you said, tech is a massive part of the US market. It represents about a third of the S&P 500. And there's lots of hype around tech, tend to be fast-growing companies, valuations are high. Yeah. You go back to the UK, I think technology is about 3% of the FTSE 100, and we have far more sectors like tobacco, banking, oil, old sectors that generate great dividends but are never going to attract those huge valuations because they're not as fast growing.
They're not fast growing. People might have sort of question marks about their future, tobacco, oil, mining. They face challenges, don't they? Because they're sort of very well established industries. They don't have the kind of sort of clear blue sky to move into that say tech has. But it is interesting. I think this chart, we can see the UK at the top there, not the sort of highest quality, but also not the worst, right? It's in the middle of the pack. And if you think back to that first chart that we saw, when the UK was way far over to the left, there can also be a kind of perception thing that isn't maybe sort of borne out in the fundamentals. I
think so. And it feeds into this narrative that the UK is quite unfairly unloved. So for years and years, everyone has had this really negative perception of UK equities, which makes it really fertile hunting ground for value investors because you can see lots of stocks where you think, this is being undervalued. But actually, we've seen a bit of a reversal of that this year because the FTSE 100 since January has actually outperformed the S&P 500 and the European stock markets. So we might be seeing the early stages of a bit of a rebound. Yeah, and look, the government's spending a lot of time and effort at the moment trying to bring that about, trying to make the UK a sort of more attractive corporate environment, because valuations like these, they will reflect maybe the composition of the stock market, but also maybe the growth prospects of that country. A lot of the UK stock market will still face the UK domestic economy, won't it? And it will still be reliant on that. And the prospects here aren't the best, versus other economies. We're not growing very fast, higher inflation, sort of higher levels of debt and things like that. Okay, finally, I did promise, Jemma, at the start of this that we would cover the cheapest and the most expensive stock markets overall right now. And that's what we can see in this final table. Perhaps not a surprise to have some of the world's smaller stock markets. And let's be honest, people probably aren't going to have dedicated Turkey exposure or Poland exposure per se, but they'll sort of make up wider funds or indices that they're investing in. But there again, we can see the US as the most expensive stock market, which is quite something considering it is the biggest. And then India, the second most expensive. Lots of people are going to have big exposures to those countries in particular. I think so. So as you say, there's lots of emerging markets on the right in the cheapest column. Yeah. And I would say, again, you don't necessarily want to buy the cheapest thing. But there are some interesting countries to look at there. And then on the left-hand side, I think what's interesting for me is India. Because we saw in 2023 and 2024, India had an absolutely spectacular run. Yeah. And then it had a bit of a wobble, but now it seems to be bouncing back again. I was looking this morning and I think a couple of their key stock markets are actually near record highs again. So I think India will be attracting a lot of attention in the next few months. Because that's actually a dip from where it had been. Yeah, but it seems to be sort of surging back, despite the fact it is very highly valued. So... And a lot of these markets, these smaller markets, beyond the States and India, Taiwan, Netherlands, I imagine that they are skewed by very big valuations on kind of mega caps within those stock markets that kind of dominate those stock markets, right? That could put a bit of a skew on these kind of country level figures. Yes, I suspect so, particularly if you've got a small stock market where you do have some really, really giant companies. So I was thinking with Taiwan, you've got TSMC, the chip manufacturer, which obviously has a huge bearing on the overall market. Yeah, indeed. Okay, well, we're just about out of time, Jemma, so I'm going to leave it there. Before we go, I'll point people to an article that you've written, Jemma, which covers all of this in much more detail. You can find that at fidelity.co.uk or just search for it. Search for Fidelity Cheapest Stock Markets. You're going to find that. And I will just remind you all that you can subscribe to the channel, give us a like or share episodes if you get a moment. That all said, Jemma, thanks for joining me.